Is Spotify, stock ticker SPOT, a buy now? We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Spotify. Then we're giving a final rating to the business. This analysis is going to be intense, but it's going to be worth it. Before we get into these valuable metrics, let's understand Spotify stock performance. Year to date, Spotify's crushing the market. They're up 92%, which is beating the S&P 500, which is up 20%. Right now, Spotify trades for $157.56 per share. Since Spotify was listed just over 5 years ago, their stock price is actually down. They've declined by $200 from their all-time highs in February of 2021. Does this mean the business is potentially on sale? Right now, Spotify trades $20 below their 52-week high. The company's up more than double from their 52-week low. Around 1% of their shares are sold short. Spotify's a big business. They have a $30.5 billion market cap. But the burning question is, why should we be paying close attention to Spotify? Spotify, headquartered in Stockholm, Sweden, is one of the world's largest music streaming service providers, with 489 million total listeners. The firm monetizes its users through a paid subscription model, referred to as its premium service, and an ad-based model, referred to as its ad-supported service. Revenue from premium and ad-supported services represent 87% and 13% of Spotify's total revenue, respectively. Now let's look at those numbers. Metric number 1, we want Spotify's average return on capital to be above 14%. This may be slightly skewed due to where Spotify's at in their business lifecycle. The company's only had 1 year with positive operating earnings, which is how return on capital is being calculated here. That came in 2021 when they earned 2% returns on capital. As the company has continued aggressively fueling its growth, it's had negative returns on capital in these other years. When this is averaged out, Spotify's had negative average returns on capital since being a public business. This is an X on metric number 1. Metric number 2, we want to see growth in their revenues, net incomes, and free cash flows. This is all or nothing. These all need to be up for it to be a check. In this time, Spotify's revenues have more than doubled. Their net incomes or their earnings have been negative in all 5 years. They've gotten even more negative, especially over their last 12 months. Again, this may unfairly penalize the business. We'll also be looking at Spotify's gross profit. Over this time, they've more than doubled their gross profit as well. Spotify's revenues and gross profits have grown by about the same amount. They've had pretty stable gross margins. A bright spot for Spotify is they've had positive free cash flows in all 5 of these years, which is what really matters for a business. It's how businesses are valued. We're using 2 different ways based on Spotify's free cash flows to estimate a fair value for the business later in our analysis, so you'll want to watch to the end. Still, even though it's positive, Spotify's free cash flows are down over this time. They earned just $30 million of free cash flow in their last 12 months, whereas they earned $250 million in 2018. Because their free cash flows and their net incomes are down, this is an X on metric number 2 for Spotify. Metric number 3, we want to see earnings per share growth in the last 5 years. This looks at Spotify from the view of an individual shareholder. We learn their earnings or their net incomes are down over this period. They've been negative in all 5 of these years, so we really want to look at Spotify's shares outstanding. When that comes into the picture, we've seen that Spotify has diluted existing shareholders. They've issued around 7% additional shares throughout this time. That hasn't been uncommon for a lot of high-growth software companies. Spotify is no exception. While they haven't diluted shareholders by nearly as much as some of their peers, this is still a fair amount of shareholder dilution. Because they've had negative earnings and they've diluted shareholders, this is an X on metric number 3. Still looking for our first check of the day. Let's see if we can find it in the back half of our analysis. Metric number 4, we want to see free cash flow per share growth. Again, even though Spotify's had positive free cash flows, in this time their free cash flows have declined. This plus their increased share count means that Spotify's free cash flows per share are down. This is an X on metric number 4. In recessions, it's businesses with a lot of debt that can have the biggest losses or even go bankrupt. Metric number 5, we want Spotify's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. In this time, Spotify's had negative net debt in all 5 years, meaning they have cash left over after paying off their debts. Using their last 12 months, right now Spotify has $1.65 billion in cash. In the last 5 years, when we add up their free cash flows, they've generated $1.1 billion. Not only does Spotify have this cash cushion, they're also cash flow positive. This is our first check of the day on metric number 5. It seems like Spotify's in a strong financial position. One thing you really want to understand is why the company's free cash flows have declined in recent years. Farther up their income statement, Spotify's more than doubled their selling, general, and admin expenses. They've also more than tripled their R&D expenses. That SG&A expense more or less grows with their revenues, but the company's also heavily investing into research and development. Even though they're a capex-light business, this level of spend is more of a substitution for software companies, especially. That's part of the reason that Spotify's earnings and their free cash flows are down. The big metric of them all, metric number 6, we want Spotify's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Spotify. Right now, Spotify has a $29 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Spotify similar to it being a private company. At the company's low point in their last 52 weeks, they traded for just around a $12 billion enterprise value, meaning their enterprise value has more than doubled in the last year alone. Even as some of the company's financial results have deteriorated, in the last 5 years, we learned Spotify produced $1.1 billion of free cash flow. This means that in an average year, they produce around $227 million of free cash flow. When that's divided by their nearly $29 billion enterprise value, we get around a 0.8% average free cash flow to enterprise value yield. On a current basis, Spotify's only produced $30 million of free cash flow in their last 12 months. They have a very small current free cash flow to enterprise value yield. Both of these are way below the yield from the 10-year treasury, meaning they're not giving us the risk premium we're looking for. On metric number 6, this is an X for Spotify. Don't just throw the business out. We still need to estimate their fair value per share and talk about our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Spotify, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Spotify's last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. Keep in mind, Spotify has not been a predictable business in their past. This is due to their very short track record as a publicly listed business, plus their high growth and declining free cash flows in recent years. This gives a much rougher estimate of Spotify's fair values than what we can look at for other businesses. It's up to you to figure out if these inputs are accurate for Spotify or not. Assuming they grow their average 3-year free cash flows at a rate of 19% annually for the next decade, then in the following decade, assuming this growth rate is cut in half and these grow at just under 10%, we're adding in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, based on Spotify's free cash flows, from today's valuation multiples, if these are the same 20 years into the future, an estimate of Spotify's fair value per share is right around $26.50. There are key points to keep in mind. Again, this is a pretty rough estimate, given a few factors for Spotify. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our rating, but we need to address something first. We've covered Spotify's finances, but there are qualitative factors that are even more important for their business. Why don't we find out what these are? Looking at the factors supporting a long thesis, number 1, revenue growth during the next 10 years should accelerate as Spotify keeps investing in different content, such as podcasts and video, attracting more users and advertisers. Number 2, by investing in more services and tools for artists, Spotify may attract artists away from record labels and toward independent distribution, which may allow it to pay lower royalties over time. Number 3, Spotify's listener growth may help the firm negotiate much better terms with record labels over time. But it wouldn't be fair if we didn't cover the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, Apple, Alphabet, and Amazon can allocate more capital toward their music streaming offerings and potentially take users from Spotify. Number 2, content acquisition costs make Spotify's overall cost of revenue variable, which can prevent significant gross margin expansion. Number 3, Spotify may remain at the mercy of record labels, which can potentially raise royalties it owns at any time. There you have it for a balanced perspective of some of the qualitative factors for Spotify's business. Now let's talk about our rating. We learned in analyzing Spotify, stock ticker SPOT, that some of the business's financials have declined in the last year or so, most notably their free cash flows. Given where the business is at in its life cycle, they've had negative returns on capital, but surprisingly stable gross margins. They've more than doubled their revenues in their last 5 years alone, but that doesn't come without some shareholder dilution. Despite Spotify's declines in their free cash flows, it looks like they have a strong financial position with more than $1.5 billion in cash on their balance sheet. Again, this analysis isn't financial advice. Right now, Spotify's free cash flow to enterprise value yields don't look attractive compared to the 10-year treasury. When we performed our discounted cash flow analysis, using those assumptions, if you want a 15% rate of return from today's valuation multiples of Spotify, if these are stable 20 years into the future, a rough estimate of their fair value is around $26.50 per share. That's impacted by Spotify's high growth, their lack of a track record, and their recent declines in free cash flows. When we look at all the factors of Spotify's business, they look like a moderate candidate for further research. Thanks so much for learning about Spotify with me. Subscribe to the channel for more videos and check out this next one.